Thank you, students. Once again, I am doing this question on Chapter 6 of Cost and Management Accounting. And Chapter 6 of Cost and Management Accounting at first year level is manufacturing statement, where we focus on calculating the cost of goods manufactured and sold. Then after, we will further calculate the income statement and sometimes applied manufacturing overheads, vice versa, the actual manufacturing overheads. Then after, we calculate our variance. So with that in mind, let me as usual begin by reading what is required before I read the information provided to me. We are required to calculate the manufacturing overhead absorption rate, and this is normally called POR, predetermined overhead rate, based on the base that is given in the information above. We are then under number B required to calculate the manufacturing overhead variance, and we know that for us to get the variance, we need to know the applied, and the applied will be calculated using the rate times this by actual base, and that will be vice versa the actual overheads. The difference between the applied, meaning the estimated manufacturing overheads, compared with the actual overheads, will give us the variance in the case where the applied, or what we estimate, is less or more than what was actually incurred in terms of overheads. Then number C, we are required to prepare a statement of cost of goods manufactured and sold, which is the manufacturing statement. And you can see the weight of the manufacturing statement is 14 marks. So the gist of the marks lie in this question. So the understanding of this question becomes very crucial, as the chapter is the manufacturing it's about manufacturing statement. Number 4, we are to draw up an income statement, or the statement of comprehensive income, or the statement of income, or income and expenses. Then the last requirement is to prepare general entries for the first two entries. And you might wonder, why do they require, or they want us to do this at the end? Why was this not number C? Because it requires us to do journal entries for number 1 and number 2, but they require us to do that at the end. It might not make sense from perhaps a student perspective who does not yet have the full understanding of this chapter. But I'll also explain why this requirement is at the end, why it is not a requirement number C. There's some other crucial thing that needs to be considered before we can do these journal entries. Now, more especially, I just want to bring your attention to number C once again, because in this question there are the inline number C will definitely be affected with number 1 and number A and number B, and also number E. So now when I'm compiling this manufacturing statement, which is requirement number C, I will do it in, I think, 2 different ways. And I will show you which method you can use, or whatever method you think is easy for you. But I'll show you both of the methods in which you can calculate requirement number C, in line also with the variance that was required under number B. Now, with that being provided to us, I just want to bring your attention to the ledger accounts that I used previously as my workings. And again, these will be my workings that will help me to respond to the requirements. The workings that I use in terms of these ledger accounts are very crucial, more particularly in this question. There are other things that you will only understand when you know how things flow from a ledger account perspective. And if you did watch the previous video that I did on the manufacturing statement, you'll note that I did not have the ledger account called manufacturing overheads. and it was for a reason of the fact that it was not necessary for me to do this, and understanding the fact that this is at first year level, and I did not want to give you this at that point in time, but in this question it is very necessary for me to have this manufacturing overheads ledger account. Then now we go back again to the information that is provided, and I will be reading throughout from the beginning until the end. Then after, I immediately respond to the question. It says CISA Ltd is a manufacturing company, and obviously this chapter is the manufacturing statement. Obviously the company must be producing or manufacturing a product. And most of the time, in the instead of the word manufacturing, I normally use the word production. So now when I'm saying production, then you must know that I'm saying manufacturing. I normally prefer the word production. The company's opening and closing balances. The company's opening and closing balances for the year were given to us as follows. And previously I said that the first balance that I prefer, or the first type of inventory, remember these are the inventories: inventory of raw material, inventory of work in process, and inventory of finished goods. I did say previously that I prefer to start with material, work in process, then after we go to the finished goods. So now we are given opening and closing balances of these ledger accounts, of these accounts. Then now opening is 25,000 of material and closing is 30,000. So now I want to record that immediately in my ledger account, and I say my opening balance is 25,000 and my closing balance of material, it is 30,000. Balance carried down, it is given to be 30,000 rands. Just record the balances that they are provided. Work in process 19 and 26,000. 19 and 26,000. So these are assets. Remember, inventory of assets or inventory of work in process. Then after we have our balance carried down, which is closing balance. Balance carried down, it is 26,000 rands. Then after we have finished goods, 35,000 and 37,000 in terms of rents, and our finished goods, it is 35,000. Opening balance 35,000, and closing balance, it is 37,000 rents. And this is balance carried down, balance at the end of the year. And these are the three balances that are provided to us. Remember, I'm just using the ledger account for or as workings. Don't use them in the exam. You might not have enough time to complete the workings of the ledger account. I just want you to understand holistically from a ledger account perspective and from an income statement or manufacturing statement perspective. Manufacturing overheads are applied on the basis of machine hours, and CISA Ltd estimated that its manufacturing overheads for the year or for the period will be 180,000 rands, and the expected base, which is machine hours, is 30,000 hours of machine during the year. So now we can calculate our predetermined overhead rate, and our POR will be budgeted manufacturing overheads, divide this by budgeted base, which is 30,000 machine hours that are budgeted to be spent over, are budgeted to be used over the entire period of the year. 180,000 rands, divide this by 30,000 rands, and this gives us 6 rand per machine hour. 6 rand per machine hour. So now this is our POR, and for us to calculate applied overheads, applied or estimated overheads, it will be our 6 rand times this by the actual machine hours. 6 rand times this by the actual hours. And when I'm saying hours, I'm referring to the machine hours, because our base to calculate our absorption rate was based on machine hours. So the minute I see my actual machine hours, then I will multiply that in order for me to get to the applied overheads. Then now we have they say the over and under applied manufacturing overheads are closed off to cost of goods sold. So now what we have calculated as our applied overheads, and we compare that with the actual, which we call that a variance, must be closed off to cost of sales. Then the following transactions were recorded. So now these are the transactions that were recorded, and I want to, I'll do that when I get to the actual overheads, the actual base in fact. The raw material that was purchased on credit amounted to 450,000 rands. So now this is the raw material that was bought, and it was bought on credit. Then the contra entry will be creditors 413,000 rands. And assuming that there was no return of material, so now if there was no return of material, that means we can say 35,000 rands plus 430,000 rands minus 37,000 rands, and this will give us 428,000 rands of the material that would have been issued. But we'll also have to consider the fact that there is material which is indirect that still have to be accounted for. Therefore, now it says raw material issued to be used in the production department amounted to 380,000 and 45,000. So let us add the two and we say 380,000 plus 45,000 rands, and we can see this is 425,000. 380 plus 45,000. 380 plus 45, it is 425,000. So now we have 425,000 rands of the material that was issued. Part of this material was direct and part of this material was indirect. So indirect material is issued. We know that indirect material is manufacturing overheads. So now the 45,000 of the material is indirect. So now meaning this 45,000 is the manufacturing overheads, but the 380,000 will go straight to work in process because it is from the material control. So now we have these two material, 438 or 380,000 and 45,000. So here now we'll have a material that will go straight to work in process. Let me just have space here. We will have work in process, and work in process will be 380,000 rands. Then after now we'll have manufacturing overheads, and our manufacturing overheads is for the indirect one. For the indirect we have 45,000. Then now we also know that we had our in the completely wrong ledger account here. Completely in the complete wrong ledger account, finished goods. Now we are in the material. Then let me just erase that. I hope you have noted it. We go to the material ledger account where we say creditors, because the material was bought on credit and it was 430,000 rands. Let me also do what I tested before. 25,000 plus 430,000, it is minus 30,000. That is exactly 425,000. Then that 425,000 now comes into exactly the total of the two material, the 425,000 exactly. And I was a bit wondering, thinking while I'm still busy talking, if exactly what is happening. So now we know that part of this material will go straight to work in process, and part of this material will go to manufacturing overheads, and the work in process is 380,000 and the manufacturing overheads is 45,000 rands. So now we can just totalize or balance our material we can balance our material. Now that will be the total, but let me just go there and read further in case maybe there is some further information regarding the material. So there's nothing else because the next one, it is salaries. Then we'll assume that there will be no further transaction regarding the material. So now I can complete the ledger account of the material, and I know that the total is 455,000. 455,000 is the total, and 455,000 is the total. And the balance carried down, remember that balance will be brought down on the debit side. It will be balance BD, and we write that 30,000, in fact not 400, that will be 30,000 of the closing balance. Due to space, then the 30,000 will be there. Just take note of that. Then we have completed the ledger account for material, and we need to record the double entries now. Under the work in process, we know that for every credit entry, work in process on the credit side of material, then material should be on the debit side of work in process, and this will be 380,000 rands. Now we have recorded that, and under manufacturing overheads on the debit side, we record 45,000. Contra entry will be material. We are transferring this material from the direct material into the manufacturing overheads because 45,000 is indirect material, and indirect material is under manufacturing overheads. So now we record that 45,000 on the debit side of the manufacturing overheads. Then we go to the next entry. As I said to you that the ledger accounts, you must not use them as your workings because it will take time for you to do such. So now we have recorded all that is needed to be recorded. Then we go to the next entry. Regarding material, all is done. Then now we come to salaries and wages that we paid by check, amounting to 160,000 rands for direct labors. So 160,000, it is direct labors. So now we know that direct labors, they go straight into the work in process. They go straight into the work in process ledger account. So now here we'll have to record wages. And when we record wages, we record the amount of 160,000 rands. Then now we go to the information once again that is given to us. They are telling us that 160,000 for direct labors, 65,000 for indirect labors, and 190,000 for salaries of the sales and administration staff. And we know that sales and administration staff is a non-manufacturing wage. So now this will not affect our production cost. So now we only have to record the 65,000 rands. Now let me just try to bring this into perspective. Remember, we have a ledger account for wages, and in this case wages were paid, and when wages are paid, a bank account will be recorded on this side, and the amount of wages when it's paid, bank does not say no, this one is indirect, this one is direct, and the bank will not separate those two. The bank will make a payment to the employees because this is paid. So now when it comes to the bank, it will be 160 plus 65,000, and our wages will be 225,000. So now we will record on this side 225,000 rands. And remember, this is an expense. This is wages and expense. Now at the end of the year, expenses are normally closed off, and from an accounting perspective, we close them off to profit and loss. But from a manufacturing perspective, which is costing, we close them according to manufacturing overheads and work in process, because we know that direct wages are going straight to work in process. So now the 160,000 will be recorded here, and the other one, manufacturing overheads, will be an amount of 65,000. So now this will be how you close off wages according to the cost and management accounting. So at the end of the day, our wages as an expense does not have a balance. It is closed off to work in process for the direct wage and manufacturing overheads for the indirect wage. That is why now the 160 go to the debit side of work in process and 65,000 go to the debit side of the manufacturing overheads. And besides, we know that indirect wage is manufacturing overheads. So now that is why we immediately record that one now under my manufacturing overheads. I record 65,000 rands, and here I will be recording wages. Why am I recording wages? Because it is from the wages expense account. So now we proceed on that same note. Then proceeding on that same note, we have recorded the wages. Let me check if it is recorded already in my, yes. Under my work in process, I have my direct wages. Remember, this is direct. And I did say to you that I will show you both of these methods when it comes to the manufacturing overheads and over and under applied. So now we proceed on the same note, and we go to the next information that is provided to us. Then we go to the next one. It says, okay, don't forget that this amount will be recorded as expenses when we are doing the income statement. It does not affect the manufacturing statement. I just want to leave it circled there. The actual machine hours is how much? 32,000 machine hours. So now we can calculate our applied overheads. And our applied overheads will be calculated by saying predetermined overhead rate times this by the actual base. And this is the actual hours in this case. And our actual hours are 32,000 hours. And if we multiply this, it will give us the applied or the estimated manufacturing overheads, which is 6 times by 32,000 machine hours. It is 192,000. So now I have 192,000. This is applied overheads or estimated overheads. Therefore, now I need to say this is my estimated. I will compare it with the actual. So the applied overheads go straight to work in process. And this is at first year level. Sometimes it's not assessed in this way, but I want to do it because there is a variance that I'm required to do. So now what we record into our production, we record our applied overheads, not our actual overheads. Therefore, now that means your manufacturing overheads on the debit side, you record actual, on the credit side, you record applied. And this applied will be work in process. Therefore, now this will be 192,000 rands, which is the applied overheads that you calculated, is the one that goes to work in process, meaning we are estimating our manufacturing overheads. Then when we actually incur, we compare what we estimated as overheads and what actually took place, and the difference becomes the variance. So now this will be the variant that we'll be talking about a bit later on. So now I have recorded my applied or estimated manufacturing overheads. Remember, this is for applied overheads. That goes straight to work in process. So now this will be manufacturing overheads, and this will be applied overheads. And in the previous question, I did not record the applied because the information did not allow me to record the applied. I would just want to caution you of that. I did not record the applied. I recorded the actually on the debit side. Hence, there was no variance that was required to be calculated. So now I have my 192,000 rands. Please make sure that you go and you watch my other video that I did on the other question, because in the case where you are not required to calculate the POR, remember, in this case, we are given our budgeted manufacturing overheads and our budgeted base, and we are also given the actual base being machine hours. And above that, we were required to calculate the rate and the variance. So now in the previous question, this was not required, and this was not provided. And again, this was not provided. The 180,000 budgeted was not there, and the expected base was not there. So now what I did in that question, and it was meant to be like that, I recorded all my actual overheads. I just recorded my indirect material, my indirect labor. So this is what you do when you are not required to calculate the variance, or there's no enough information for you to calculate the variance. You just record the actual overheads on the debit side. But if you are required to calculate the variance, then you must calculate the applied overheads and you record them on the credit side of the manufacturing overheads, and you record only one amount on the debit side under work in process, the one amount of the applied, as opposed to recording the actual. So please be mindful of that and take note of it. In the exam, it can be asked in any perspective, honestly. Just be cautious of such. Now, I will proceed in that same note. And in that same note, just undo. Yes, in that same note, we go now to the information that we are provided. And by looking at this, we do have the opening balance. I just want to come to the working process now. We do have the opening balance, direct material, direct labor, and applied overheads. So now the minute we have these three, then we can draw the line, and when we draw the line, we can check how much is the value of the inventory that was completed. So now we can say opening plus material plus 380,000 plus 160,000 plus 19,000. Don't know why I'm cancelling now. 19,000 plus 380,000 plus 160,000 plus 192,000, which is applied overheads. 192,000. This gives me 751,000 rands, and this is 751,000 rands minus 26,000 rands of the closing inventory. Therefore, now meaning 725,000 rands of the work that was in process was finished. So this will go straight into finished goods. Now I'm assuming that there was no return of inventory to the storage department. So now this 725 will go straight into the finished goods, and we record this as 725,000 rands, and the contra entry will be work in process. So now with that being said, then we go back to the notes that we are provided. Now we go to the notes that we are provided, and the notes that are provided to us, I was just responding to this one. Then we are told that selling and admin cost, apart from the salaries and wages, remember we had sales and admin, which was salaries. Apart from those one, we had 105,000 that was paid. We also have factory rent. Now factory rent was paid, and I want to bring your attention again to my ledger accounts that are very crucial. When an expense is paid, remember this is rent as an expense. So now if this is rent as an expense, meaning and the rent is paid, so now we will record our bank on the debit side of rent, and we look at how much of this rent of factory that was paid. It was 35,000 rands. So now we say our rent expense was 35,000 rands paid. Remember, bank is decreasing on the credit side. So now we need to close off this expense, and we know that because we are doing production statement, or we are in the manufacturing, expenses that are indirect expenses must be closed off to manufacturing overheads. And we know that rent is an indirect cost, meaning it's the manufacturing overhead. So now hence we close off this expense to manufacturing overheads. That is why now this 35,000 will be recorded on the debit side of the manufacturing overheads, and the contra entry will be rent. Now if you look at what I'm doing, the contra entry, I'm not saying bank, because bank was already recorded as the contra entry when I was paying my expense. And now in this case, the rent expense is closed off to manufacturing overhead, the amount is 35,000. So now that is why now I don't record even when it comes to the working process. I did not say bank here, though other people will say bank and say bank here, but it's not necessary because you are closing off this expense and you are closing it off from the manufacturing overheads, which is closing it off with the manufacturing overheads. So now from a ledger account perspective, that will mean that this is how our rent will be recorded. Then after we proceed to the first information that is given to us, then now it says sales for the year, or before that, other manufacturing overheads incurred on credit. How much? 40,000 rands. They are not paid, they are incurred. So now we can have a ledger account. We don't know which one to be specific, they did not tell us. So now we can have a ledger account that says other expenses. Remember, these are other expenses that are indirectly related to production, meaning their overheads. So now in this case, we'll say creditors, because we did not pay for these overheads. And now we take the amount of these overheads that were not paid, and we record the amount of 40,000 rands. They were not yet paid, so now we have to raise the liability, increasing our creditors by 40,000 rands. And we need to close off because this is an expense account. It must not have a balance at the end of the period. So now we close it off to manufacturing overhead because this 40,000 rands is a manufacturing overhead expense. So now hence again we have 40,000 rands, and we go back now to our manufacturing overheads and we record 40,000 rands, and this will be other expenses or other costs. So now with this being said, and this was the last entry to be recorded because the last, or the one before the last, is sales, 1,250,000. When you do the income statement, therefore now we'll be recording those sales. Now from here we can draw the line and we check if is our overheads over or underestimated. Then now we have to say 45,000 plus 65,000 plus 35,000 plus 40,000. This is 185,000 rands. We actually incurred 185,000 rands, but what we applied was 192,000 rands. So now we have 192,000 rands at the big amount, 192,000 rands at the big amount, minus 192,000 rands. This gives me 7,000 rands. 7,000 rands is falling on the debit side, which is the smaller side. 7,000, and the contra entry for this will be cost of sales. This will be cost of sales, meaning now our cost of sales, remember, cost of sales is from the cost of goods that were finished, meaning these goods are overestimated by an amount of 7,000 because we calculated the cost of the goods that are finished based on the applied overheads of 192,000 rands, not based on the actual overheads of that 185,000 rands, which was the total of the two. And now because of that, it means our cost of sales must be reduced, meaning the inventory that was finished must be reduced by a total of 7,000 rands. So now we go to our cost of sales and we say cost of sales on the credit side. We say cost of sales, the contra entry will be manufacturing overheads, and this will be recorded as 7,000 rands. Now let me now go to the ledger accounts are completely done now. Then we go again to the information that was provided to us. So we have accounted now for all that was or should have been accounted for. Now I'm just analyzing and looking at what was sold in actual fact, but they did not clearly state. We have the sales 1,250,000 rands. Therefore, now we have to calculate the cost of sales. Now we have to go straight to our cost of sales. I just did my workings. Then now we go and calculate the cost of goods that were sold. So now we have the finished goods, which amounted to 725,000 rands. And those finished goods will go to the finished goods ledger account. And we recorded that in our finished goods ledger account. And we did not, we still had the balance carried down that I erased by mistake. And that balance carried down for the finished goods is sitting here, closing balance of finished goods, 37,000 rands. It was when I made the mistake that I erased this one, 37,000 rands. Remember, it's the finished goods ledger account that will tell me how much is the inventory that was sold during the year. So I need to know how much of the inventory was sold during the year. So now I can be able to say 35,000 on the debit side plus 725,000. And this gives me 760,000 rands minus 37,000. Then this will give me 723,000 rands of the cost of inventory that was sold. So this is the cost of what was sold. Then the contra entry will be cost of sales. Why am I saying that is cost of sales? Because inventory that was available for sales during the year was 760. And out of the inventory that was available for sales amounting to 750, the only one left at the end of the year is 37,000. So what happened to the rest? We say inventory available for sales minus inventory left at the end of the year. That will tell us how much of the inventory was sold during the year. So now we have recorded that. Then we proceed by recording the 723,000 under our cost of sales, because for every credit entry there should be a debit entry, 723,000 rands, and the contra entry will be finished goods. This will be finished goods. So now if you look at our cost of sales account by the end of this period, our cost of sales will be the difference between the finished goods and the overhead or the over-applied manufacturing overheads. So now when we totalize our cost of sales by the end of the year, our cost of sales will be 723,000 minus 7,000. So now we'll have 716,000 rands as the cost of sales. So now this will be 716,000 rands. That will be the accurate amount of the cost of sales. And this will be, let me leave the closing of the cost of sales, which will be closed off to profit or loss. So this is the one that goes to P&L, profit and loss, closed off to profit and loss. Now, when we are calculating our cost of goods manufactured and sold, it will give us 723. Then after, we need to deduct the over and under applied in order for us to get to the real amount of the cost of sales after the over or under has been accounted for. So now let me go now to the formal calculation. Remember, we first need to know how much material was used. And our material used, we know that it will be, material used will be made of the opening and opening, or in this case they already told us how much material was used, if I'm not mistaken. They told us how much material was issued into the production department. They said that direct material amounted to 380,000. So material issued was 380,000 rand. So there is no necessity for me to be worried and be recording the opening and the purchases. So now I already have that 380,000 which was direct. So this will be material used 380,000. Material used 380,000 rands. Then now I need to say plus direct labor. And when I plus, let me also do all this calculation, though they are appearing in the ledger account, just to make sure that there is consistency. The material used, remember, it would have been opening plus purchases, and opening of the material was 25,000. Not mistaken, yes, it was 25,000, and purchases for 30,000. Therefore, now we'll have our opening as 25,000, purchases 430,000. Then after we have to minus our closing, and our closing, it was 20 something, 20 or 30,000. It was 30,000 material used, or material left at the end of the year, 30,000 rands. Now I just want to bring the across the fact that if you say 25,000 plus 430,000 minus 30,000, it gives us 425,000 rands. Remember, this 425,000 rands include the 45,000 rands of the manufacturing overheads. So now hence we also have to say less manufacturing overheads, or less indirect material. In other words, let me just say indirect material. Less indirect material, because I want to know only what is the direct material used. So now I have to minus that 45,000 rands of the indirect material. Therefore, now if you minus that, it will give you material direct that was issued into production. So please be mindful of this note. Now in the previous question, they did not say that there was indirect material. Hence, I just said opening plus purchases minus closing. It gave me what was issued. So now, hence I'm saying in this case, you already know what was direct material issued, and direct material issued was already 380,000 rands. So now let me just confirm that my figures are right. 25,000 plus 430,000 minus 45,000 of the indirect minus closing of 30,000. It gives me 380,000. Then after we say place or plus direct labor. And when I add my direct labor, which my direct labor is 160,000 rands. Direct labor 160,000 rands. This will give me what you call prime cost. And the prime cost will be plus 160,000 rands. It will be 540,000 rands. That is direct material plus direct labor is equal to prime cost. Then now we have to say plus applied overheads. Don't forget, applied manufacturing overheads. And applied manufacturing overheads amounted to 192,000 rands. Amounted to 192,000 rands. So now we say plus 192,000 rands. This gives us 732,000 rands. Then this will be production cost during the year. Production cost during the year. The cost of production only in the current year. Now, if you look here, we have 380,000, which is direct material, direct labor, and applied overheads. This is very much consistent with the work in process. Work in process, we had material, we had labor, and applied overheads. Those must always be aligned together. So now what we need to calculate in order for us to know how much was finished, we need to say plus opening in order to get to 751 minus closing in order to get to what was finished. So now that is why we continue on that same note. We say plus, let me just change my color, plus opening work in process. And opening work in process is 19,000. And when I add my opening work in process plus 19,000, this is 751,000. 751,000 is a work in process, or the value of the work in process during the year. That is the value of the work in process during the year, or process rate, or process rate, value of the work in process during the year, if I may say so. Value of the work in process during the year. Value of work in process during the year. And you don't have to write all this heading that I'm writing. Then now, after we have the value of the work in process during the year, which is this total of work in process during the year, in other words, total of work in process during the year, we need to say minus closing, because we said 751 minus closing. So now we do the same thing here, we say minus closing. That is why now we deduct that 26,000. Then we say less closing work in process. Then now, after we say minus closing work in process minus 26,000, this gives us 725,000 rands, and this is finished goods that were finished during the year. So now this become our finished goods. This become our finished goods. Therefore, now we say these are finished goods, and they are transferred straight into the finished goods account. That is where now we have transferred that 725,000 here, which was from the work in process. In the work in process, we had finished goods that were recorded on the credit side. The 725,000 is this one. It was finished, no longer in process now, and the minute it's no longer in process, it gets to be finished. And we transferred this into the finished goods ledger account on the debit side. So now, meaning this amount of 725 now of the finished goods is exactly where we are on the debit side of the finished goods. Now we know that from here we need to say plus opening balance in order for us to get to the inventory available for sales. So now that is why now I go again and I say plus opening balance, plus opening inventory, and this is inventory of finished goods, and the opening inventory of finished goods is 35,000. Then I add that 35,000. Then after adding the 35,000, I get inventory available for sales. This is what was available for sales, and we can see that it is 760,000 rands, 735 plus 35. It is 760,000 rands, 760,000 rands. Then this is what was available for sales, but at the end of the year we can see that what is left is only 37,000. What happened to the rest? That means what was available minus what is left will give us what was sold. So now that is why we need to say less closing, less closing inventory, and our closing inventory is 37,000. Therefore, now after we deducted the 37,000, we get to 760,000 minus 37,000. It gives me 723,000 rands. This is the cost of sales before adjustment, or before adjusted. This is the cost of sales and the cost of goods sold, and I'm saying before the adjustment because we still need to take into account that variance. So now we took this into the cost of sales, and we recorded this into the debit side because the minute inventory is sold, therefore now it is cost of sales contra entry from financial accounting perspective now. So now this is where we are, and we say, remember, the cost of this 725, the cost of this 725, the cost of this 725 was calculated by saying in the work in process, opening plus material plus labor plus applied overheads. This is what was estimated. So now we estimated that our manufacturing overheads will amount to 192,000, but our manufacturing overheads were not 192,000 rands. If we added the actual overheads, our manufacturing overheads, they amounted to 185,000 rands, if you remember that. So now we recorded our production cost to be 192,000 rands, but in actual fact it was 185,000 rands, and we realize now that the cost of this 725 is overstated by the difference of 7,000 rands. So the cost of goods sold must be reduced by 7,000 rands. So now that's why we come again and we say this is the cost of sales before the adjustments. Therefore now we have to say manufacturing overheads, which is variance. That variance we talk about, which we calculated it to be 7,000 rands. So we reduce it here, and the minute we reduce this here, we say minus 7,000 rands. This gives us 716,000 rands. So now this is the final cost of goods sold. This is the final cost of sales. Final cost of sales. You don't have to say final. I'm just saying final because it's after I've taken into account the overestimation of the manufacturing overheads. So now this is the manufacturing statement that was required to you. And I want to bring in terms of reminding you into the fact that we recorded our manufacturing overheads as 192,000 rands. If we were not required to calculate our predetermined overhead rate, if this information was not there, this 180, and there was no 30,000 budgeted base, and this was not required, and this was not required, then there wouldn't be a need for us to record that 192,000 rands, because there wouldn't be a way to calculate that 192,000 rands. So now this becomes very crucial. That means if it was not required, therefore now what we're going to do, we're just going to record here the amount of 185,000 rands. Remember that 185,000 rands, it comes from the calculation of the manufacturing overheads actual. This and this and this and this would have given us 185,000 rands, meaning our overheads would have been recorded at actual, not at estimated. So now if you record overheads at actual, you don't calculate the variance. You don't calculate the variance of 7,000 when you record your overheads at actual. But if you record your overheads at applied, therefore now there's the necessity for the variance of 7,000, which that variance must be adjusted against your cost of sales. So now please be mindful of that. I know I might be giving too much information in terms of the ledger account from a first year, but I think it's very crucial for a broader understanding of this topic at large. Now, we have done the manufacturing statement, and the next part now is, in fact, I have to go now and respond to the requirements and see if am I directly responding to them. We were required to calculate the POR, and we did that. This was number A. This was the POR. Then I want to go now in order of the questions because I'm already now doing the third requirement. I'm done with the third requirement. So let me note that this is number C. That my focus is on the major part of the question. So this is number C that I've done. This is number A that I've done. Therefore now I need to do number B. Number B, we were required to calculate the variance, and the variance is 7,000 rands. So now the variance that we are required to calculate, it is the variance, overhead variance, and our variance is 7,000 rands. So our variance, we can say variance is the difference between what you estimated and what actually took place. The variance will be applied minus actual, and our applied is 192,000 and our actual is 185,000 rands, and I've already done this in the ledger accounts. How is it in the ledger accounts? Under manufacturing overheads, I did the variance there, and my variance was 7,000 rands. There was my variance, 7,000 rands. 185 of the debit side minus 192, my variance was already calculated from the ledger account perspective. So hence I'm saying the ledger account are holistic in terms of the approach. So now we have responded to requirement number A, requirement number B, and requirement number C. Then we have to go to requirement number D and draw up the income statement or the statement of profit or loss or the statement of comprehensive income. Now in this statement we know that it's very straightforward. Sales minus cost of sales, we get to the gross profit. Sales, our sales are 1,250,000 rands. I hope I am right with that. 1,250,000 rands, and we need to less our cost of sales. We need to less cost of sales, and our cost of sales, we just calculated them from the manufacturing statement. Our cost of sales, I'm not going to just take this amount. I want to show you all the calculations, and I want to again bring your attention to how we got into the cost of sales. Cost of sales are from the finished goods. The minute you sell the product, meaning it must first have been finished. So now when I'm calculating cost of sales, I'm looking at the opening balance of the finished goods, and I'm looking at the closing balance of the finished goods. Then after I say how much was completed during the year, the one that came from the working process, the inventory that was finished during the year, then now that will tell me about my cost of sales. So now hence the cost of sales format says opening, and this is opening finished goods. This is opening finished goods, and the opening finished goods, then after we say plus production or completed during the year. Let me say that completed during the year. I'm just writing all these terms. Completed during the year. Completed during the year, meaning inventory that was completed during the year. But that is not the right wording. It's just for you to understand that is what was completed during the year. So this will be plus production cost during the year, inventory that was completed during the year. Then we need to say minus closing inventory. Closing inventory, remember this is inventory of finished goods. Then we need to say plus or minus the variance. Now that will be plus or minus over slash under applied. It will depend either is it over or under applied. So now we had our opening finished goods, and our opening finished goods were 35,000 rands. And if you want still, you can just come here 35 plus production finished goods. This is finished during the year. Want to specify during the year, DTY, during the year, finished during the year. Opening plus finished during the year minus closing. It will give us 723,000. Our opening inventory was 35,000. Opening inventory is 35,000. Completed during the year was 725,000 rands. Completed during the year 725,000 rands. and you can see that was finished goods, 725,000 rands from the work in process. In all angles, it is the same figure. So now we record the 725,000. Then our closing inventory of finished goods. Closing inventory of finished goods, it is 37,000 rands. There is the closing of finished goods, 37,000 rands. So now we record the 37,000 rands. There was an over-applied overheads. When overheads are over-applied, the cost of sales are decreasing. So now the net of this will give us the same amount of 716,000 rands. So now we have 35,000 plus 725,000 minus 37,000 minus 7,000. It is 716,000 rands. And the 716,000 rands is the cost of goods sold. So it's the same amount. Then after we get to the gross profit. And our gross profit will be minus 1,250,000 rands. This is 534,000 rands. Then after we say less other expenses, meaning less non-manufacturing expenses, if you want to say so. Less non-manufacturing expenses. Then our non-manufacturing expenses, the first one was this one, 190,000, which is salaries for the admin staff. Then I record that as salaries, 190,000 rands. I don't have to say for admin staff. What is important, it is salaries. Then we had selling and admin cost. We had selling and admin cost. Selling plus admin cost. And selling and admin cost is an amount of 105,000 rands. I record this as 105,000 rands. And I go to the next expense. The next expense is not there. We don't have any other non-manufacturing cost. Remember, the 65,000 was indirect labor, and indirect labor is part and parcel of the manufacturing overhead, which is a production cost. Therefore, now let me just confirm we only had the selling and admin 105,000. We only had the 190,000 of the salaries for the admin staff, and we don't have any other non-production or non-manufacturing cost. So now with that being said, then we can have the total of these two costs, and we deduct them from the gross profit, and we get to the profit for the period before tax is taken into account. 534,000, or let me start by adding 190,000 plus 105,000. Was it 105,000? 106, oh, 105,000, correct. So plus 105,000, it is 295,000. 295,000 being negative minus 534,000. Then this will give me a total of 239,000 rands. So now 239,000 rands is the profit for the year. I don't like to say net profit because there's still some other expenses, finance cost, taxation expense that need to be provided by the end of the year. And obviously this income will deserve a taxation. Let me then go to the requirements and see if did I respond to all of them, or there is the last one. The last requirement is to record general entries in response to the first and the second entries. So now I'm recording general entries, which I've already done that in the ledger accounts. Remember, this we calculated POR, which became 6 rand, and the variance was 7,000, if you remember. So now, after we calculated the POR, we multiplied it by 32,000, which was actual hours, and that gave us 192,000 rands, and of which that 192,000 rands, if you remember, was recorded on the credit side of the manufacturing overheads. So now that 192,000 rands, remember, this was our applied overheads. So we need to also take that into account, that the applied overheads was recorded as the general entry. So now let me then do my recording in response to the last requirement. I think it's D. So we will debit our work in process by 192,000 rands, and we credit manufacturing overheads by 192,000 rands. Let me bring this to attention that we do not record the POR of 6 rand. POR is just used to calculate our applied overheads. The 6 rand of the POR should not be recorded as the general entry. But after multiplying this by the actual base, we got to the estimated or applied overheads, of which that applied overheads was recorded as a debit under work in process. There we had applied overheads 192,000 rands, meaning work in process is debited and manufacturing overheads are credited by 192,000 rands. Contra entry is work in process. So now we have recorded first that part of the applied overheads. Then now we need to then draw a line and we record now the other part of this variance. And we determined that there was an unfavorable variance, or there was a variance that was overstated, in other words, let me not say unfavorable. Then after we calculated the 192, we said 192 vice versa, or compared it with 185. And we realized that 7,000 is an overestimated of the overheads. We estimated 192, but we actually incurred 185. Therefore, now our manufacturing overheads were debited, if you remember. Manufacturing overheads debited by cost of sales. So now that means we have to record this general entry where we debit manufacturing overheads by an amount of 7,000 and we credit our cost of sales by the amount of 7,000 rands. Hence I'm saying ledger accounts make this very simple, honestly. Now we have done that. And also when you come to the cost of sales ledger account, you can see that cost of sales are credited by 7,000 and cost of sales are credited by 7,000 rands. So remember that the general journal is the direct instruction of what need to be done in the ledger account. So let me then check if is there anything perhaps that I might be missing in this question. Then now we have recorded the two general entries and there was no one that affected, there was no one that is needed. Thirdly, we have done the applied, we have recorded the variance, so there is nothing else that honestly need to be recorded. If I'm forgetting any general entry, I will apologize for that. So that was in response to the last requirement. Prepare journal entries to record the first and the second transaction. Let me just again go align it with my ledger accounts, check if is there anything that is missing. We calculated the applied, the recorded, then after the applied, the variance. Yes, so that's all that was needed for this question. And I hope you have understood and got some broader perspective in terms of compiling the manufacturing statement or the cost of sales. Remember, this is cost of sales, not only the manufacturing statement. It is the cost of sales. I hope you have understood how to calculate the cost of sales. So now that is the entire manufacturing statement that was required. So guys, with that, let me say thank you. God be with you. Have very wonderful study life. Don't forget to subscribe so that you can get video updates at any time I'm uploading a video. Subscribe to the channel and get updates of the knowledge of accounting. Thank you guys.